Let's go over the dividends that I received in April and a couple of changes that I've made to the portfolio. We're also going to have a look at how we're tracking in terms of dividend income. So we'll go over the 3 dividends that I received first. So first of all, I got realty income. Get this every single month. It is a REIT, which stands for Real Estate Investment Trust. It basically just means it is a US business that invests into property. They buy property, they rent them out. The rent that they receive, they then pay 90% of that as a dividend. If you're a REIT, you have to pay over 90% of your income as a dividend to qualify as a REIT and all the benefits that you get. It can be a volatile business, so when you have COVID, for example, and everyone ran out of offices and buildings, realty income didn't do too well. It hasn't performed anywhere near as well as the S&P 500, for example, and it is not generally a business that performs exceptionally well, but what it does give me is it gives me exposure to property, which I don't have elsewhere apart from my house. I don't want to have to buy a property in the UK and rent it out and deal with all of the hassle of that. Can't be arsed. And it pays me on a monthly basis. So despite its underperformance, despite the fact that you have to pay FX fees, I like it, and I'm going to keep it for, well, as long as it keeps doing what it keeps doing. So the realty income dividend paid me £13.63. So that's based on £3,400 that I hold within realty income. I'm 10% down with that. The current dividend yield on that is 5.02%. So the dividend is tasty. The performance is bad. My performance is bad, but I'm happy with it. The second dividend that I received in April then was from my emerging markets fund, my Vanguard FEM. Have to get that right. So that's to the distribution version of that fund. You can get an accumulation version of it. Now that paid me £21.54, but this is where I made my first change over the last month. So I talked about it before. I sold out of that fund. I had about, I'll put the transactions on the screen here, 4,100 in there, and let me explain the reason why. So that represents just under 4% of my portfolio, which then would assume that I have 4% into emerging markets. So you'd think that that's not too bad a position to be in terms of diversification geographically and across developing versus emerging. However, when you look at the all-world fund that I hold, which is the Invesco FTWG, that has an allocation into the emerging market at the moment. I've jotted it down here. So we've already got Asia emerging and LATAM and a couple of other countries in the Middle East covered, representing 8%, nearly 7 to 8% within the Invesco fund into emerging markets. So if you think I've got £50,000 into my all world and I've got 7 to 8% in there, that means that I've got £3,500 to £4,000 in emerging markets already, on top of £4,000 into emerging markets through my emerging markets fund, which means that I'm ending up at around £8,000-9,000 into the emerging markets in £100,000 portfolio. So that then becomes 8-9%. Long story short, too much exposure to the emerging markets. I've got it covered already in the Invesco fund. Don't need to overcomplicate it. So I sold out of it literally today before I did this video. It went at 1%. I use that as an opportunity to sell it. And I use that cash to go into my all world. That's typically what I do. Every time I sell anything, I just use that to put it into my all world. And that's worked pretty well for me over the last few years. If you're interested in the emerging market fund, here it is here. So the dividend yield is 2.59%. It pays on a quarterly basis. The expense ratio, the cost to you, is 0.22%. In terms of the performance over the last year, up 2%. Over the last 3 months, it's nowhere near been as affected as the S&P 500 and the all world. And the max is 4.85%. It's pretty volatile, as you can see. Now, it only goes back to 2020 on this, on Vanguard, on Trading 2 and 2. Longer than that, you are going to see better performance. The emerging market is... we see great gains in it when we see gains, but we see big drops in it when we see drops. So it kind of exaggerates the other markets. A lot of people have a lot of faith in the emerging markets going forward, and they believe that there could be significant growth. And if you think about all of the businesses that are within those countries, a lot of those businesses could see exponential growth. For me, I'm more than happy to keep the coverage of emerging markets that I have within my all-world fund. The last dividend that I received then was from VUSA, V-U-S-A, which is the Vanguard distribution version of the fund. Distribution just means it pays a dividend, of course. S&P 500. Now, as of today, the S&P 500 is down 13.16% over the last 3 months. But if we look at the week view, 3.68%. Look at the one-day view. I'm recording this on Thursday, the 1st of May. 2.21% up. That's based on some news that's coming out that China want to come to the table to have some conversations about some tariffs. but it's going to be a tumultuous year, to put it lightly. So my total S&P 500 is on 13.38% up. I hold £31,000 in this ETF. That's versus my £50,000 that I hold in my all world. It pays quarterly as a dividend. It has a low dividend yield, 1.26%. Every dividend that I receive, by the way, gets reinvested back into these businesses. Expense ratio is 0.07%, which is pretty bloody cheap. And based on those numbers, I got a dividend of £95.57. That gives me a total April dividend income of £130.74. So we will have a look at the charts in terms of what that's done to my dividend income since I started. But first of all, if you haven't already started with this sort of stuff and you want to start with trading 2 and 2, there is a link in my bio, or you can use promo code Neil. All you need to do is deposit £1 and you'll get a free fractional share as a result of doing so. There's no platform fees on trading 2 and 2. It's easy to buy and sell. It's where I hold pretty much all of my current wealth. You're protected by the CAS rules, so a lot of people don't realize that the FSCS £85,000 protection is slightly different to investments. So investments have to be held separate from your broker under CAS rules in the UK, which means if they do go under, they're held separately. You're going to get them back. You're also protected by the FSCS, of course, £85,000 cash on held within your account as well. Let's just jump onto the computer then and see how we're doing in terms of the dividends received. This is what my dividend chart looks like at the moment. You can see it's not peaked as much as it did do previously, but we are still waiting for those significant June dividends to come in, which I'm really bloody looking forward to this year. The trend line is going in the right direction as far as I'm concerned, so I'm more than happy with it, and I'm going to keep tracking this going forward. We've also seen a bit of an improvement here on my 10-year financial independence tracker, so this has pulled up a little bit versus last month, and that has taken £4,500 worth of deposits and a little bit of gains as well in order to do that. This is just the volatility that comes with investing into the market. As you can see before we were well ahead of that blue trend line that we needed to be keeping close to. So this is based on assuming a 9% growth rate over the course of the 10-year period that I started this. And it has to be expected that you're going to see this volatility, these ups and downs. That's just the way it goes. Right, that's it. So 3 dividends this month give me over £130. Obviously, that's passive income. That's as passive as it gets in terms of dividend income. If you've got any questions, let me know. And if you want to see my entire portfolio, have a look at this video here.